Hello everyone, welcome back to Nandu's Equity. We all want to really book profit at the right time and exit the stock before it goes down. However, nobody can really predict the market or a stock price. There are ways that we can safely book profit and ensure that we do not lose the profit at least. In today's video, we are going to see 10 major tips that can help us in booking profit like a pro. The first step is like reaching profit targets or goal. This sounds quite stereotyped and very easy and common, but most ignored. One of the fundamental principles of successful investing is to have a very clear plan before even we start investing. Before entering any trade, ensure to establish specific profit target. This could be a percentage gain, a predetermined price level, or a combination of both. For example, if you are a growth investor who follows Slim method or any kind of growth investing, they generally set 20 to 25% of profit as a target. And similarly, they will also keep 7 to 8% as their stop loss level. This disciplined approach ensures that you lock in gains and avoid the temptation to hold on to a winning position for too long. The second method is about monitoring valuation. So you should keep an eye on the valuation of your particular stock or investment. If a stock becomes overvalued and based on its fundamentals, it might be a good idea to consider taking profit. For example, if you have purchased a particular stock at P ratio, say less than 20 or 25, over a period of time, say the P ratio goes above 75 or 100, you can decide to exit and reinvest only after it comes down to your entry level again. Meaning, again, it comes down to your range of 20 to 25 in the P ratio, then only you can enter. Otherwise, whatever profit you have booked, you can move to some other stock. The third way to take profit is to take it incrementally. Consider taking profits in stages rather than all at once. For example, you might sell a portion of holdings when a stock reaches a certain price target and then let the rest reside if the stock continues to perform well. The fourth method is to take profit and leave the capital as it is. For example, if you have invested 1 lakh rupees in one particular stock which has already come to about 20 to 25,000 as profit, just sell the shares worth of only 20 to 25,000 and keep the capital amount of invested money as it is in the stock. Trailing stop loss orders are a powerful tool for managing risk and securing profit. Unlike traditional stop loss orders that have a fixed selling price, trailing stop loss orders automatically adjust as the stock price moves in your favor. For example, if your current price of a stock is about 1000 rupees and you have set about 10% drawdown like 900 as a stop loss and you set it as trailing stop loss. Imagine if the stock goes to 1100, automatically the 10% from 900, it will set the new trailing stop loss as 990. And similarly, if it comes down but it does not touch 900, it automatically adjusts in the lowering side also. So like this, when you are not very clear but you want to adjust based on a percentage, you can set the trailing stop loss like this. This strategy allows you to benefit from upward momentum while limiting potential losses if the market takes an unexpected turn. Diversification is a key strategy for managing risk in your investment portfolio. When certain stocks or sectors outperform, they can become a more significant portion of your portfolio than initially intended. For example, you have a general area of about 10 different sectors invested with 20 different stocks. So in the current time, like defense and railway stocks are doing extremely well. So you can rebalance your portfolio, invest most part of your portfolio into railways and defense. So periodically you can rebalance your portfolio by selling some of the outperformers and reallocate that fund into undervalued stocks. This strategy not only helps lock in profits but also ensures that your portfolio remains aligned with your risk tolerance and financial goals. Similarly, that could be long-term underperformers in your portfolio, where you have no hope for those companies to come back. In those cases, you can move that money to your performing companies. Tax implications. This is one of the things most ignored because of poor awareness. So, understanding the tax implications of your trades is often overlooked but can significantly impact your overall returns. So, there are opportunities during the end of financial year time. If your portfolio having several underperformers which are showing negative or loss, you can still book loss and take it for the adjustment. And similarly, you can avoid booking profit at the end of financial year, postpone booking profit little later, like after the financial year, so that this year you can avoid taxes. Booking loss has always seen as a negative thing, but if you do not book your losses at the right time, that could make a big dent in your overall portfolio. So anything that violates your investment thesis, you should definitely consider booking loss. Even if the fundamental reasons, like you initially invested in a stock that no longer holds true, or if there has been a significant change in the company prospect, it might be good time to cut your losses. Also, there are chances like a company would come into news for various bad reasons. Then rather holding on to it, it's better to book losses. Good example could be if a company's financial health deteriorates, its management changes for the worse, or the industry landscape shifts negatively. Always re-evaluate your investment in that case. And there could be worst case scenarios like if a company is found to be violating policies or audit measures or involved in any kind of fraud, immediately decide to move your money to other safe companies. Technical analysis signals are most ignored by investors, and many do not have proper awareness also. So pay attention to technical indicators such as moving averages, trend lines, and support levels. Some basic thing to follow is like anything above 200-day or 300-day moving average is good to hold. When it is testing and coming down, better to exit. And similarly, RSI you can check for overbought and oversold zone. Anything is moving towards above overbought zone, then you can decide to sell. So you can definitely have a detailed view of all the technical signals like trend. Sometime there will be trend reversal. So when the stock goes into trend reversal, it's better to exit. And similarly, supply and demand zone is another thing if you are a swing trader to consider. An example is like if a stock breaks below key support levels or consistently trades below its moving average, it could indicate a weakening trend. Setting predefined stop loss levels based on the technical analysis can help you exit a losing position before further declines. This way you are reducing or avoiding major loss. Establishing risk management rules is very critical for protecting your portfolio. Similar to FOMO, fear of missing out, people also having fear of losing out. So avoid emotional trading or emotional investments. So emotional decisions can lead to impulsive action. For example, if you are a long-term investor, drawdown for short period of time should not impact your portfolio as far as your overall portfolio theme, target, goal, all that is kind of intact for longer time. So some of us, what we do, if there is a news-based crash for 1 or 2 days, we fear that we will lose everything. We end up, booking loss or booking profit in a very early stage. Then after a week or after a few days, we realize that we did a mistake because the market recovered and taken everything to a new higher level. This has happened multiple times in the recent time in India. So best thing to do is sticking to your investment plan and avoid making decisions based on fear or greed. Having a disciplined approach can help you avoid any kind of costly mistakes. Thanks for watching. If you find this video to be useful, please click the like button, and if you have not yet subscribed to my channel, kindly subscribe. Thanks.